Welcome to Between Two Chairs, Demystifying Commercial Real Estate, the podcast that brings you the latest insights and trends on the South Florida commercial real estate market, with your hosts, Fernando Arencibia Jr. and Jennifer Woolman. In each episode, we dive into the world of commercial real estate and break down complex concepts to make them accessible for everyone. Whether you're a real estate professional, a curious investor, or just interested in the South Florida market in general, Between Two Chairs is the podcast for you. So pull up a chair and join us.
All right, so you're letting me do the intro today.
So everybody's got to learn somehow.
Everybody's got to learn somehow. So baptism by fire. So we were chatting the other day and decided to make this episode about the words or the investment strategy, buy low. So the title of this episode is Buy Low. And everybody, whether it's in stocks or real estate, any type of investment, you always hear people say, well, buy low, sell high, that's how you make money. Well, duh. You know, that's kind of what I feel like. Well, what does that mean? What does buy low, sell high mean? And how do you predict when the right time to buy is? So everybody always says in the stock market, yeah, buy low, sell high, but it's hard to predict the market, right? Because it's just basically a guess. So with real estate, we're a little bit more lucky in the sense that there's definite real estate cycles. And at some point in time, that cycle is going to be lower than it is high, and you're going to see it starting to go down, you're going to see a bottom, and then you're going to see it starting to go up. We talked about different experiences that we had, you know, in buying low. You know, if people look at when I bought my house in Miami, I don't know, 30-something years ago, if they're waiting for the price to go back to that, my son always says, well, of course, you bought low. Well, guess what? When I bought back then, it wasn't low. It was low compared to now, but it wasn't low. When I bought my first investment property, we did a syndication. We bought at the height of the market. We bought right before the recession. We bought an office building. We paid top dollar. Interest was high, but it was a super well located office building. There was a ton of demand for office in that particular market, which was in the South Miami area. And we just sold it last year, and we made a really good return on that. So did we buy low? Absolutely not. We bought high. We bought at the height of the market. Did we still make money? Yes. Why? Because it was in a good location and all of the financials were sound, right? Yeah. So what does buy low really mean?
And I think more importantly, is that really at the top of your criteria when you're acquiring investment commercial property or really any kind of real estate, right? Because it is part of the criteria. Price is obviously going to be part of the criteria. I find that the most successful commercial real estate investors don't put that at the top of the list when they are weighing what criteria is more valuable than others. Otherwise, people would never buy an asset that has appreciated tremendously year over year, for example, right? And the reality is that it's very difficult to time the market.
Correct.
And to be a wise real estate investor, you have to have in your array of underwriting a property, because that's ultimately what you do as an investor, is you underwrite the property, which means you're going to study the income, you're going to study the location, the future valuation, you're going to study what upside you can add, the quality of the property, the quality of the tenants, all those items to determine not only whether, number one, do you want to acquire the asset, but number two, at what price does it make sense for you to acquire the asset. Very difficult to time a market, and it doesn't only apply to real estate, it applies to stocks as well.
Oh, of course. And the market isn't the same for every asset class either, or in every market. Like we just said in our last podcast, the Miami market right now is very strong.
Correct.
Even though the rest of the country is not. Does that mean we're going to continue upward, and everyone else is going to go through a downward cycle and we're not? Of course not. It just means that the cycle in Miami is going to be different than the cycle in other states, right? And within an asset class. So office is an asset class that is kind of hurting everywhere, but maybe industrial doesn't hurt because even though demand is decreasing for industrial, there's still so little of it.
So I want to share, because I know this is a commercial real estate podcast, but we all own our own home, and so at the end of the day, this is an experience that I think a lot of people can relate to, because it may not have happened exactly this way for you, but I think it is a relatable story, which is, I bought a house for my family and myself 6 years ago. And the day that we're moving in, this little old lady is walking down the sidewalk, and the neighbor had already told me about her. So listen, she's always walking up and down the neighborhood, and she likes to get to know people, and she likes to really develop relationships. She's one of these neighbors that is involved in everything. And she was a person that had no filter, and so immediately the first thing she asked me was, what did you buy the property for? Now, look, it's public records. It shows up. So I told her my price. And then she was like, oh, my God, I cannot believe you paid that much for the property. I cannot believe I paid $64,000, for the property. Back in 1979, I remember.
Were you even born in 79?
I was born in 79. I was born before 79, I'm happy. I don't have a problem divulging my age. So I was 5 years old in 1979.
Okay, so you couldn't have bought that house in 1979.
No, I couldn't have bought it. Right, exactly. And look, that's a valid point, right? There was no way. But it's interesting because I got a great friend of mine years ago. He's renovating his bathroom, right? And at the time, it was going to cost him $7,000 to renovate the bathroom, right? And this is over 20 years ago. And his dad was like, $7,000 to renovate the bathroom. I can't believe I paid $2,500 to renovate my bathroom 10 years before that. And he goes, Dad, the Whopper is also not 25 cents anymore. If you do the comparability,
Right.
And that's what I wanted to tell the lady, like, Señora, the Whopper is not 25 cents anymore, so. But what I do find interesting is about this, buy low, is that I've had conversations with a lot of people. We've gone through a huge amount of price appreciation in the Miami market over the last 3-4 years. And look, this is very personal to me. I still go and get a haircut. Now, I know it doesn't look like why I should be going to get a haircut.
For those of you that aren't looking at us on video, he is bald.
Okay, well, look,
well, he does have facial hair.
I think
and
that's a little exaggeration. Yes, I have the facial hair because I didn't want my barber to just make money for shaving my head. So I gotta give him a little.
Too.
He's gotta do a little something. But I go to my barber, and one of the barbers that sits in the chair next to my barber, he's always talking to me about real estate. And for 5 years, he's telling me, I got this money saved, I want to invest. And he's had every reason in the book why I think that the market has to adjust. I think that we're due for an adjustment. It's been 5 years. If he would have bought 5 years ago at those prices, he would have experienced at least a 56% appreciation. He would have had incredibly low interest rates. He would have had an incredibly performing asset. He had an opportunity to buy a fourplex in Westchester, which is a tenant-heavy area in some areas in Westchester. He would have done extremely well. And it was a property that was built in 1981, so it wasn't an old property. 4 units, all 2 bedrooms. He would have done tremendously well. And every time I see him, and I just saw him this week, I just tell him,
waiting?
You're still trying to time the market, and there's no way to time the market.
Right. But that being said, it's true, right? If you are really dialed in to the market, or you work with a professional who is dialed into the market, you're going to get a fairly good idea as to where you are in the cycle. I mean, if all of a sudden, if we've built, 3 million housing units and rents are going down, or we've got a ton of vacant retail stores, and every strip center you go to has 5 or 6, empty stores, and people are giving away, 5-6 months of free rent and a ton of TI, then you can say, okay, we're either at the bottom or we're going down. right now in Miami, we're not seeing that, right? We're not seeing
Right.
huge vacancy rates. We're not seeing a ton of TI.
Right.
And we're seeing a lot of demand,
Yeah.
right? We still have people even now that when I have two people that are coming down here from the Northeast, they're expanding their business, and I specifically ask them, are you sure? Because what you're seeing in the Northeast, you're not going to see here. You're still going to be paying higher rents. You're going to get very little TI. You'll get some, but you're going to get very little. And there's not a huge amount of room to negotiate that because there are 4 other restaurants who want your space. So that is kind of part of it. But you can look at a cycle and try to maybe not, you're not going to get the absolute bottom unless you're really lucky, but you can kind of gauge where you are.
But I think what you're referring to is not necessarily timing, but it's more about the market fundamentals.
Correct.
So, for example, you're looking at, well, is the property that I'm buying, is the inventory saturated? Is there too much inventory? So, is there no upside here on that valuation? Is it difficult for me to get tenants? Is it going to be very expensive for me to convert the property because I have to make it smaller based on new tenant requirements? What is going to be my TI? What is going to be my total investment after I buy the property? So let's look at some items. And one is obviously is the location. You want to understand your market. You want to understand how that piece fits within the marketplace and what is going to continue to add value.
Right.
And I think that those things are important. You're going to look at the property condition, right? Because you're buying something. If I'm buying something that is brand new, then I have deferred capital improvements. I don't have to make that additional investment. I know I don't have to put a roof for 10 years. And I know that even my TI is minimal. That has a lot of value. So I might not be buying at the top of the market, but I might be evaluating that for 10 years, I'm not going to have to add another penny to this property, right?
Correct.
Or very little amount of money into the property. You're going to look at the tenant quality as well. Is there going to be high turnover? Is there going to be a lot of management expenses in order to manage the property? So that's another item that is going to be important in that requirement. You're going to look at cash flows, of course, because real estate, commercial real estate is about the numbers. So we got to make sure the numbers are right. Any future development plans. And here's where it gets interesting, right? And lastly, I'll say financing options, because that makes the deal, where price might be at the top. But to your point, if he would have bought if this gentleman would have bought 5 years ago, he would have been in an environment in which he would have been able to lease that to get a loan for below 4%. Yeah. Right, so the inexpensive amount of capital that he would have been able to utilize would have really made his internal rate of return a lot higher on that asset. Now, let's talk a little bit about this future development plan, because I think that that is an element of property valuation and timing the market and when to buy and all stuff that is important. And I'll give you an example. And what I mean by that is the property that you're buying utilized at its highest and best use at the time that will generate the most income and that's going to generate the highest return on the investment. So I have a client who was looking at, this is many, many years ago, again in North Beach, looking at this 18-unit apartment building to buy as an investment. He was running the numbers, and I remember it took us a little bit of time to get it under contract. We have it under contract. We have to close before the end of the year. This is like end of November, so we got about 30 days to close. He's running into about 10 days left on his due diligence period, so he's got to make a decision. He calls me and he tells me, Fernando, I don't think the numbers work. I'm concerned. We're paying at the top of the market, right? At that time, $100,000 a unit for 18 studios. The average at that time was about, you could get away with $75,000 to about $83,000 a door. This property had been renovated, had a brand new roof. So again, there was some value added already in the property, fully leased. But now he's telling me the numbers don't work like that. But it just so happens that because when you're representing somebody in an area, you want to get to know the area. And in that transition, we have met 2 doors down, literally 2 doors down, a lady that had converted her apartment building into a hotel. And it was a 10 key hotel. We call them keys in hotels. So she had 10 keys. She had built this beautiful pool and a restaurant in the back. And she was telling us that, look, we're making money on the restaurant and the place is full. But I made a mistake. I have too few keys. 10 units, it's not enough. 10 keys is not enough for me to really make it work. So I remember that conversation. I remember that we had a good rapport. And I told my client, okay, I want you to go back and reevaluate this asset, not as a year-over-year 365-day lease,
Rental.
right, rental, but to look at it as you already have this lady that has created a nice branded small hotel. She has the infrastructure in place, the software, everything ready to go. She is at full capacity. She doesn't have enough rooms for the number of people that have. Her demand is super exceedingly. Can you convert those 18 units into also hotels so that way you can go ahead and make a deal with her, use her same infrastructure. She instantly adds another 18 units, so she almost triples her pool of keys of units in the hotel, and now the numbers will work. He looked at the average daily rate. He looked at what she was earning. He called her. He comes back and goes, Fernando, it's a no-brainer. And from that day on, everything else went smooth, and we closed the deal by the end of December. So he acquires the property. He never does any of that because he realizes that the rents were undervalued. He did a couple things to the building. He was able to increase rents, but he always had that in the back of his mind. Like, I could always do that. And in a matter of a short 4 years, that property ended up selling almost at twice its price. Mm-hmm. And that's what I mean by when you're looking at the situation, a lot of people want to look for, they want a deal. They call you, I want a deal. I want this, but sometimes you have to create the deal, right? You have to find creative ways in which maybe this property is not being utilized and it's being sold for one purpose, but it has a higher and better purpose where the numbers now, make sense. And in that time, he bought at the height of the market. He wasn't timing it, right, as if, per se, but the fundamentals were there. Right. And the fundamentals in the area also supported the purchase. It wasn't that this was the reason why he bought it. There were other aspects that really cemented the decision on purchase.
Right. And again, not to poo-poo all of the economists and investors and everything who say buy low and sell high, because if, let's say he found that deal and he had bought it at the bottom of the market,
of course,
right? Then, okay, yes, he would have made more.
Yes.
But the other thing is, would that have been available? Would that property have been available or something like it? So I think timing the market involves predicting the market. You can guess the cycle, but the reality is, to your point, is if you find a deal or you can create a deal where there isn't one, but to your point, that location was great because it allowed for it to be a hotel or value-added multifamily, buy it. Don't wait for the market to go down. So
you said something that is really interesting here because. And I'll go back to this because I think it relates. Do you know that the majority of realtors overpay for their property? Have you heard that stat? It's not really an official stat, but I'm not saying investment, but I'm talking about the home that they live in. That most realtors will usually pay top price or above asking for the home that they're buying for themselves. And the reason for that is because, to your point, guys, we're not selling something that's coming out of a factory floor. These are not widgets that are cookie cutter and the same. Mm-hmm. And what a realtor knows that a lot of people don't know is that property that you like might never come back on the market, or one like it might not be there.
Right.
So you got to take advantage of when you go into a real estate market, you're buying the inventory that is there or the inventory that might be there within the time that you're doing the search, right? But you're limited to a degree by what the inventory is available. And so, I've had a lot of investors that look at the whole paradigm and they're like, there's nothing to buy. Everything is overpriced, whatever it is. Then I have investors that really know a market and know an area, and they're like, it's going to be very hard for me to find something like this in the next 5 years. So I'll buy it now at today's price because I know that the appreciation will be there, and I know that there are things that I could do with the way that I manage that property that are going to add value.
Or if you look at an area, you could be looking, and Wynwood is a prime example, right? With Tony Goldman, he just had that eye.
Right.
He didn't wait for the bottom of a market, right?
No.
He just bought properties as they came available because he saw the potential of that area. Yeah. Or you look at the developers in Allapattah. So the people who got in at the ground floor, I can't even tell you, was it a high market or not? I don't know because, they got in. Yeah. But it was a lower priced market in the Miami hotter market.
For sure.
And so they got in there low, right? So they got in there low, but there's still so much room for growth within Allapattah if the people who had the vision, if that vision comes to fruition, right?
Yeah.
So
That brings up another point, which is that, I think a wise investor has a thesis for their investment, right? They have an approach, they have a blueprint for what kind of investment they want to make, and the reason is why they're investing, and that has to do with asset type, that has to do with location. And I once heard Tony Goldman speak at a ULI event, may he rest in peace. And, for those of you who don't know, he had a hand in the development of Soho in New York, and I forget the neighborhood in Philadelphia.
Yeah.
He was a visionary. And I heard him speak, and he says, I think that in order to turn around a neighborhood, his thesis was, you need to come in there and you need to acquire a minimum of 13 to 17 properties. So you got to have 13 to 17 properties that you control. Then he says, then you have to make sure that you bring the artists, you bring all the creative people, and that you give them an outlet, and that you give them sustainability. That is not just a flash in the pan, you're here just for now until I bring up the value, and then you're kicked out, right? But that it has sustainability. Then he says, but now I can't do it on my own. So now I have to set it up so that other investors come in. I need other developers, I need other people to come in and join me in this fight to make sure that we create a sustainable, growing neighborhood. And that's what he was able to do. But that is a very, and I know we'll discuss this later, but I've had clients like that are either specific about geography, or they're specific about their asset class, and they're specific about what they're going for. And for me, that is super exciting for me, because now it's almost like we're trying to apply a very methodical approach to investing. It is not a one-off, right? And it has a set of criteria that have been, created. An investor, they say when you buy a stock, you got to buy a stock with the sale price in mind, right? And you make the money when you buy, and it's the same thing with real estate. And so every investor that is looking, and they're not like, well, I can't buy low because 5 years ago this was cheaper. No, they have a theory that in the next 5 years, this is what's going to happen. And it's going to be based on all the items that we discussed: location, cash flow, tenant base, what's happening in the area, knowing what kind of economic engines are occurring, what are the moves that the municipalities are making. All those things add to the decisions that we make. And so to purely go by buy low, you're going to miss a lot of deals, and you're going to miss a lot of opportunities.
Correct.
And at the end of the day, all of my successful investors have a timeline as well. I'm going to add one more thing, because I've said this in a presentation at MIPIM. The number one word in real estate is, location, 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 right? That's the number one word in real estate. But the second word, and I forgot who said it, but somebody said it at CNBC when they were having a conversation about real estate investing, is timing, timing, timing. But he says, but people misunderstand that aspect. They think it's about timing the market and buying low and then selling high. But what they are not understanding is, if you buy and you hold and you improve the property and you improve the quality of the tenant and you improve the amenities and you do all those things and you give that time, it's as if it was a part of a recipe. And it is probably the most difficult thing to do. But if you give that time, you're going to have a wonderful cake to eat at the end of the baking process, right? And I think that is, the point of not getting stuck on this idea of buying low.
That's a great point. And so it's really not timing the market, it's time in the market. And I think one of a better saying might be, instead of buy low, sell high, might be, don't wait to buy real estate and wait. And that's the way to make money in real estate. And, if you look around Miami, we have a lot of new people coming and investing, but we have a lot of families that have been here for decades and decades and decades. And they have property that they never sell. They never sell.
Correct.
They hold it, they change it, they update it, they tear it down, they rebuild it, but they don't sell it. So I think I think I like that better than buy low, sell high. And the reality is that buy and hold. And the reality is that if you're investing often enough, you are sometimes going to time the market. It's a little bit like dollar cost averaging and buying stocks. Yeah. If you find a deal and you're always setting aside some amount of money to invest in real estate, whether it's buying it directly or through a syndication or whatever, if you find a deal,
and the last thing I will say about that is really understanding the market that you're buying into and understanding every aspect of it. I can start working with a client that is looking for an investment property, and the first property we see is the best property. But because they have no time in the market, meaning that they haven't studied the market, they don't see what an amazing opportunity that is, right? And sometimes there's going to be that doubt of whether I'm overpaying, is this the right investment, all that stuff. But the more time that they study the market, they're looking at properties, the easier it becomes for them to, when they see a real value, for them to say like, wow, that is an incredible buy. And sometimes that's why I think that successful real estate investors are real fans of looking at real estate and lots of it, and really getting to know an area and getting to know a market. And that's very important.
And at some point, that investor doesn't even need to get into numbers. I have two investors. They're both multifamily, and they just loved an area. This is the same woman that I took to Little Havana, and she saw the roosters, and she's like, no, I'm good with Coral Gables. But we would look at the numbers, and she's like, oh, I don't need to look at numbers. Just show me the building. And she would walk into the building, and if it felt good, she would buy it. And I'd be like, ay, ay, ay. Like, that scared the hell out of me. I'm like, oh my gosh. But it felt right to her. And the reason I finally realized is she had been looking at enough to know. Like, she didn't need to know what the numbers were with that building, because she knew, given the neighborhood and how many buildings she had seen and the other ones that she owned and what she'd rented them for. She just knew, walking into a building, that if it felt right, she would buy it. And if it didn't feel right, she wouldn't buy it. But without knowing that at the beginning, that's the benefit of having years of experience. If someone just says, oh, it feels right, I'm going to buy it, let them, because they've been in the market enough. And the same thing with my other investor. She's bought a ton of properties in Coconut Grove. And she's the same way. It just feels right. And she'll go walk down the street, and she's like, whatever comes up on the street, I want to buy it. I like the energy on the street. So that just goes to show you there are a million different ways to buy investment real estate.
What it is true is that people that have bought it and held it have done well, over time, because real estate as an asset, it's a growing, it's a bank, it's a savings that you have there, and there is always potential for growth. That is really a cool perspective, because I do remember taking care of a client one time, and they saw a property and they were like, oh, there's so much to do here, and I got to renovate this, but she really wasn't feeling it, Then we went to the next property, and she walks in and she goes like, oh, she looks at me and she goes like, are you feeling this? Are you?
And you're like, no, it's a
job. It needs way more work. And I'm like, this is way, like, you told me you didn't want to do, renovation. Like, this is like down to the studs kind of thing. And she goes like, but I like it. I think it works. I think we could do well. So,
So she bought it.
She bought it, and she did do well. And she did a beautiful renovation and all that stuff. So it's great. All right. So we've come to that time.
I went first last time. So what's your fun stat?
All right. So listen.
Do you like that name, fun stat?
Or not really? It could work.
It could work.
It could work. So I was pulling up this. So this is really not much of a stat, but it's to the point of the corporate, because I was reading this a month ago, and then something else connected me to it, which is that, Miami continues to be a magnet for corporate relocations. Last month, we had global banking giant Rothschild & Company sign a lease for its first Miami office. Silicon Valley tech firm LeverX moved its global headquarters to the Magic City. And the local IT company, Kaseya, I'm so sorry, guys, announced that 3,400 job expansion. And then what did we find out yesterday? That the Miami Heat have agreed on a 17-year naming rights deal with Kaseya for their home arena. So now
$117 million.
$117 million gets you the beautiful arena right on the bay, named after you, and it's going to be called Kaseya Center. So the Miami Heat.
I wonder if they're going to be able to fit that on there. I still see FTX on there.
I think that they will, and and I'm sure they'll do it. I think $170 million buys you, a few revisions on how they look, and
Yeah,
I'm sure those letters are going to look great in every aerial shot, one way or the other. So
it's a pretty arena.
it is a pretty arena, and because if anybody from Casella is listening, we are both very happy to go
Yes.
into your booth and visit you guys, and
Yes.
attend one of the games. I know it's going to be a lot
And
of fun.
thank you for giving our beautiful arena a name and
right. That's
helping
right.
fund it, because having it be the no-name arena was a little depressing.
Exactly.
Very
yeah,
depressing.
Yeah, absolutely.
So now I don't know if I can call mine a fun stat, because it's kind of a downer maybe, but if you do subscribe to the buy low theory, Casey Conway, the Red Shoe economist and the economist for the CCIM Institute, has been warning for over a year that we're getting ready to go into a big recession. And he's warned that the commercial real estate value decline is going to be significant because we've had 8 interest rate hikes so far. And he's saying that the CRE assets value could face 25% declines based on all of the CMBS and loans that are coming due, the fact that people did buy at the height of the market when cap rates were, really, really low, and now you can't refinance anywhere near what the rates were. So if you do subscribe to the buy low, you might be wanting to keep your eyes out in the markets you want to be in, because there may be some good opportunities.
Yeah.
There
Again,
may be some good opportunities.
Right, and suffice it to say, Casey is speaking about national numbers.
Correct.
So,
This is national.
a lot of our market, again, going back to the idea of insulation, because we're seeing an incredible demand on a lot of asset classes in commercial. I do believe that if there is some sort of adjustment on the CRE level, I believe that we have some,
some insulation. But we did also see during the height of the COVID real estate rush, we did see some pretty incredible cap rates where people were paying, 3.5, 4 cap, and the interest rates were still at 4.5 to 5. So,
but I'd be curious to find out how many, like for example, in the industrial sector, how many of those purchases were end users. Because as you know, their calculation is different, right? And so I always wonder about that, because a lot of the major competition for price appreciation came from end users. And some of that had to do with them getting EIDL money and having the ability to buy instead of renting. So,
that's correct. And it depends, again, it goes to asset class, right? If you're buying multifamily or self-storage, you're not an end user, right?
Correct.
So, so again, going back to the original point that buy low, not every asset class is at the low at the same time in a cycle.
Exactly.
So.
But it's all an opportunity, and that's the way to approach it. So, all right. Well, listen, another one in the can. Thank you guys for joining us in between two chairs. All right. We'll see you soon.